Welcome to Daily Digests for July 23, 2026. U.S. stock markets suffered their sharpest single-day decline in 3 years as the S&P 500 dropped 90.66 points to close at 7,408, breaking below key technical support at its 60-day moving average of 7,437 with an opening gap down. The technical breakdown signals a momentum shift across major U.S. indices. The S&P 500's close below its 60-day moving average, combined with a downward opening gap, indicates that sellers have taken control of short-term price action, breaking the sideways consolidation pattern established earlier this month. A primary driver of today's sell-off was a sharp energy shock. Brent crude oil prices spiked back to $100 per barrel following overnight attacks on crude oil tankers in the Red Sea. The sudden escalation in Middle East geopolitical risk has reignited inflation concerns, dampening market expectations for aggressive rate cuts. Beyond headline index pullbacks, institutional investors are executing a fundamental pivot in how they evaluate megacap tech. Rather than rewarding top-line AI expansion, Wall Street is now penalizing heavy capital expenditure programs that erode free cash flow and reduce return on invested capital. Alphabet provided a prime example of this free cash flow penalty. Despite reporting a solid 24% revenue increase to $119.8 billion for the second quarter, capital spending doubled year over year to $44.9 billion. That surge pushed Alphabet into a negative free cash flow of $5.9 billion, its first negative quarterly cash flow since its 2004 IPO, sending shares down 7%. Tesla faced a similar market reaction, plunging 14.5% after reporting its first quarterly cash burn in 2 years, with a negative free cash flow of $1.09 billion. Automotive gross margins compressed to 16.8% due to price cuts and rising investment in its $25 billion annual AI and robotics CapEx program. In contrast to cloud provider cash flow strains, semiconductor hardware components showed operational strength. Intel reported second quarter revenue of $16.13 billion, up 25% year over year, and beating analyst estimates of $14.43 billion, driven by robust demand for PC and data center chips. In macro rates, 10-year U.S. Treasury yields approached 4.7% as markets priced in persistent rate pressures. Capital competition between $12 trillion in forward Treasury refinancing needs and over $800 billion in U.S. hyperscale AI CapEx is pushing up the systemic cost of capital across financial markets. In enterprise software, OpenAI formally launched OpenAI Presence, an agentic software suite designed to automate core back-office business workflows. The move intensifies competitive pressure on traditional SaaS business models, sparking concerns of seat-based revenue compression. In international commodities and shipping, the Strait of Hormuz closure has extended past expectations into late July. While China has mitigated immediate shocks by shifting 1.4 million barrels per day of oil demand toward EVs in early 2026, prolonged maritime choke point disruptions continue to add friction to global supply chains. For technical traders, international leads suggest potential mean reversion setups. Korea's EWI ETF hit extreme technical overextension at 154 to 156, gapping 1.2 average true ranges outside its Bollinger Bands, providing a potential lead indicator for U.S. memory chip price action. Systematic funds represent another key market risk. Quantitative CTA models have seen their stop-loss flip points rise alongside recent highs, meaning a further 150 to 200-point decline in the S&P 500 could trigger systematic sell programs and accelerate market downside. To recap today's digest for July 23, 2026, monitor 7,437 as immediate S&P 500 overhead resistance, track energy inflation impacts from $100 Brent crude, and prioritize companies with positive free cash flow over speculative CapEx expansion. Thank you for listening, and we will see you tomorrow.